Vamos falar de fintech e criptomoedas e para isso tenho o prazer de chamar aqui ao palco o Paolo Fortelli. O Paolo é Head of Product da Finoa. Paolo, welcome. Um aplauso.
Thank you, everyone. Sorry, first apologies. This is going to be in English. As my girlfriend likes to say, my Portuguese médio. So if we want to keep this clear and loud, let's go on with English. Hope it's not an issue for you. Thanks for the intro. Thanks for having me today. We're going to mainly talk about crypto and how it is blending into fintech. We're going to see what is the institutional adoption today that is being manifested along the last years, and what are the emerging trends that are driving usage in crypto. First, though, let's have maybe a look at the history of crypto. How did we get here? What is going on also in terms of technological trend? And then indeed we can see how adoption and use cases are evolving. So this is how Bitcoin has been evolving. In 2010, in May, the first recorded physical goods were bought with Bitcoin. Does anyone know what was the first thing bought with Bitcoin? Exactly. How much is that pizza worth today? Do you know? $20 million. So yeah, it was a very expensive pizza. And nowadays, luckily, there's a bit more people that are not just buying pizza with Bitcoin, and we actually have a stable 1 million active addresses using the cryptocurrency. This, of course, is a massive feat. Today, crypto is on track to grow with the internet adoption, for example. That's why there is a lot of belief in it. But what's more important is that with Bitcoin, a new industry actually evolved and emerged. So looking back today, we see that crypto is a $1 trillion industry. We have thousands of projects around it. And we see also that despite bear markets can be very harsh, this is where actually things are happening. Bear markets, we say in crypto, are made to build. And for example, that's when Finoa was born, but also when DeFi was born. So what is here is important is that indeed it's the ecosystem that is following certain technological trend. When we look at the applications, we must define essentially three main defining shifts. The first is with Bitcoin, and Bitcoin solved the following problem. How do I create a digital currency that is preventing double spending, that can be decentralized and still be secure, trustless? So Bitcoin solved that. It's decentralized, there is no central authority, and it does prevent double spending, so it can be used. But then nothing happened for about 5 years, until Ethereum came about. And with Ethereum, the main paradigm shift was that now transactions are not just initiated manually by a user, but they can be programmed for. And it's not just financial transaction, it can be execution of contracts, execution of IP, intellectual property fee rights. Everything can be programmed and self-enforced. It's an immutable piece of software, so nobody can change it, that just works the way it's designed to be. And it's transparent, meaning everyone can verify how that smart contract is going to work. So with Ethereum, then there was a Cambrian explosion of applications, but one main problem: it doesn't scale, meaning we have very little throughput. Yeah, today Ethereum, well, not today anymore, but before the change to proof of stake, Ethereum could process just 10 transactions per second. That's nothing. Visa is about 15,000 transactions per second. So how do we solve these problems? By having better consensus mechanisms, and by having different layers built on top of this basic layer that solve for security and solve for decentralization. And this is what we see with the instances like Polkadot or like Ethereum 2.0 that just completed the merge in the last weeks. This is solving then two main problems: scalability, but also blockchain interoperability. The beautiful thing about Web3 and crypto is that there is not a winner-take-all market. There are certain layer ones, or so-called basic layers, that are winning, and here you see some of those. And then there are a huge ecosystem that is now being built on top, the so-called layer 2. With this, we can build massive use cases because we can replicate social network, insurances, financial products. Everything is built on top and can be scalable. And now you get Visa scalability on a decentralized system and on a trustless system. So how do we get to this? Why so many applications? Why so many actual use cases? These things are being used. Yeah? It's not just pure speculation. And the answer is developers. People are flocking to the ecosystem. They are running away from normal Web 2, from tech in general, and they're entering crypto. Of course, as you can see from this graph, the big peak is happening during the bull market. Yeah? So the first meaningful flocking of talent was from 2016 until 2018, more or less. But then the remarkable thing is that, in my opinion, it didn't drop. It just stopped growing during the bear market, and then it started growing up again with this uptick. And this is, of course, again, now we are seeing sort of slowdown, but crypto companies today still have the problem. Fino is one of those. We don't find people to hire. We don't find skilled people to hire. So there is a huge investment that we need to make to train these people, besides very smart guys, of course, but we don't know where to find them, so we don't hire just in Germany or in Portugal. We hire everywhere we can, and then we need to train them because there is not enough trained talent. Still, this is also to say that it's not just Bitcoin and Ethereum anymore. As you can see from this graph for the data nerds, Ethereum here is definitely the one that has the biggest developer base, and is still very much retaining it. So everything above the line is successful projects that are retaining developer from 2020 all the way to end of 2021. But we also see there are some new projects that are growing very, very fast. They are not nearly where Ethereum is already, but things like Solana, Near, that are all addressing or so-called Ethereum competitors, they are growing 5x the way that Ethereum used to grow. And so these projects are very much well-positioned to bite some of the market share and cater for specific use cases. So without developers, there wouldn't be use cases, there would not be, of course, applications, there would not be investor interest. Yeah? I think to close this first part of the presentation, I quote one of the biggest investors out there, and that has become a huge crypto advocate, Mark Arnerson from A16Z, saying that the vibes from crypto essentially are what used to happen with the internet, with Web 2, or with smart contract. So it's a very promising trend that we are seeing developing today. And probably what's remarkable is that for once, this trend has enticed first institutions rather than retail individuals. How is this happening? So who are the people that are investing today in crypto? Besides us individuals, I don't know if you would invest, but there is a lot of money already into the system. And of course, the first actors were the native investors. Companies like Pantera Capital or like Dapper Labs, they were in the ecosystem, they had received money from investors, they needed to deploy it. They needed to either create application by themselves, therefore they were funding other talents, or they were just spearheading an industry. Then, institutions that are more risk-prone, like venture capitalists or like hedge funds, started entering the space. And today we will see later that venture capital is actually the sector of institutional actors that is driving all the trends. We then saw more traditional investors coming in. And one key aspect of it is because up until last year, interest rates were depressed. So these companies didn't know where to make an yield. And so they started actually looking into crypto, maybe Bitcoin, maybe Ethereum, because they are considered the safest one, or stable coin products that are generating a yield. Thing is that today we see names like Ray Dalio, Fidelity Investments coming in. Last but least, I think I see many young people here. It's important to note that fintech is a big crypto adopter. I say this because most of us are fintech users. We may use Revolut, we may use Square, or PayPal, of course. And these are the companies that, from the traditional financial world, that first adopted Bitcoin or first gave exposure to retail, to crypto in general. And so from these companies, we expect a large thrust into the adoption, mass adoption of crypto. Where are we now? So we're quite not yet there with mass adoption, as you may notice. But if you go from the crypto developers to the cypherpunks, now we are in a moment where family offices are investing in Bitcoin, or in crypto in general. There has been a huge run in such a small amount of time. That's why I think it's quite remarkable, and it gives very much the vibes of smartphones or the internet. I think what we are really missing today is the most traditional institutions. Those companies, especially now with the bear market, got again cold feet. They all have Bitcoin on their agenda. It's just somewhere in a drawer maybe now, but they will pull it out as soon as they see that the trend is actually reverting back to growth. And this is, again, something from Fidelity that is one of the main actors today in the space. This is to give a bit the idea, like, now it's still very much about high net worth individual in Europe. You can see it's huge, the amount of people that are already investing in crypto. Not so much for institutional investors. However, when Fidelity did this survey, they discovered that now advisors are starting to suggest up to 16% to their customers in allocation of crypto. And this is up from 9% last year. We also see companies like hedge funds, again, so more risk-prone. There are now there is a good 20% that is allocating a substantial portion of portfolio to crypto. We're talking about 5% or more. Still, on the flip side, we still have about 60% that is completely shunning out of it. Yeah? And the lion's share, as I was saying before, is VCs. They started very slow, but on the run-up to 2021 and first quarter of 2022, never has been invested so much in crypto. They have raised swaths of money, and of course, now in Q2, the trend has slowed down, but it's just a slowdown in the investment part, in the deploying of capital, but actually fundraise is an all-time high. In 2022 alone, the top 12 funds have raised about $12 billion, and now it's all ready to be deployed. It's let's say, loading up the dry power so that they can buy cheap. Yeah, that's actually what is happening today. So all of this makes us think that crypto is here to stay. There is actual usage. And as I was saying before, with this layerization of applications, many different use cases, it means that investors are becoming more sophisticated. They just don't want to buy and hold anymore. They want to participate. If we look at an institution today, there are two main ways that an institution gets access to crypto. It's either via a custodial provider, like my company, or it's either via funds, like Galaxy or Vanek. Yeah, these kind of structured products that they give synthetic access to crypto. All of these service providers now are having a huge pressure because they need to deliver much better experiences to the customers, to their investors, by allowing participation. There are certain key drivers of participation today that we're going to look at now. First and foremost, staking. Does anyone know what's staking? More or less? Let's just quickly go for it. So staking per se is the way that people participate in the protocol to make it secure. It means that you buy some tokens of that protocol, of that project, that's a stake, and you lock it into the project, meaning you dedicate it to make the project secure. And if you behave well, what you do is that you get a reward. And this reward is very much like an interest rate because it's a percentage of what you have invested. That's something that resonates very well with institutions. It's not like mining. I need to buy hardware. I need to spend a lot of electricity. I need a technician 24/7. No. I just buy some tokens, lock them here forever, and I earn a reward. And the interest rate, we're talking about something like, on average is 6.5%, as we will see, but it can go as high as 20%. So again, compared to what we see in the interest rates today, it's very much enticing. On top of it, I think it's very important to mention liquid staking, which is essentially, think again, you locked now these tokens in the protocols, you cannot use them. That shouldn't be the case. These are tokens, these are values, so you have a position which is locked. You can synthesize the position, get a synthetic token on it, and use it for other kind of investments or trade it. It means that it's like when you buy a bond, you get your piece of paper, ideally, and then you can trade it back to someone else, right? That's what the same you can do with liquid staking. Yeah? So it's a very new financial way. It resonates very well with investors, to the point that out of 1 trillion in market cap today, 250 billions are staked. This means that validators, so all the companies that are engaging into the service of staking, are having a sort of hard time because they need to support all of these needs. It's a hard time worth 18 billion a year in revenue, though, so not that bad. On-chain governance is a very important trend as well. Back to staking, if you are having your tokens, it means that you're owning a share of all the tokens available for this protocol. With this, usually you can vote. So if you are an investor, you have spent a lot of money to invest into a given protocol, you want to ensure that you have your own say into how the protocol decides what's the roadmap going to look like. How do we invest our treasury? So we are seeing investors that demand to their service providers ways to engage in active voting participation on these projects. And this raises some sort of ethical questions around decentralization. We saw, for example, in 2020, a protocol like Curve, that is one of the biggest DeFi protocols with billions of dollars under management, that was essentially managed at 70% by the founder, after raising some millions of amount of dollars from VC. So that's on one side, it's worrying for the investor because it doesn't have enough power, but also worrying for the community because they essentially are at the mercy of one single staker. Today we are seeing slowly some improvements in the way that governance is actually arranged, which, unsurprisingly, in my opinion, is very much similar to the way we organize governments. Yeah, it's not like very much organizing companies, but it's more like organizing states. And you delegate, right? We vote people so that they can help us deciding what to do with our country. Very much so in protocols like Aave, you have delegations, and so you have maybe only 5 main managers of the protocols, but these persons are accountable towards a lot of people that have delegated their token to them. And everything, very important to say, is transparent because it's on-chain, meaning that everyone can verify how these persons are behaving. DeFi is, of course, another main trend, born out of the 2019 ashes in the bear market. Today, well, as of now, only 100 billion under management, more or less, with a peak of about 250, and many different use cases. The main one is decentralized exchanges, so really swapping of tokens, like we could go on Binance or Coinbase, but those are centralized. This is decentralized. It means that there is no KYC. It means that we can participate into market making, meaning that we can actually be contributors to these markets, much like institutions would be in the real world. And last but least, I guess you have heard about NFTs, but it's not just the funny JPEGs here. We really see today real-world use cases getting into Web3. We see, of course, the piece of art that is being digitized, but we also see gamification, so the metaverse. We also see real-world assets that are being tokenized into the version of NFTs and then traded, or fractionalized and traded. So this is a huge, yet the newest trend that we can see in crypto today. But you can see VCs are already betting hard on it. From 2020 all the way to the end of 2021, the share of investment has increased 7 times. So summing up, we see from store of value, buy and hold, in the span of almost less than 5 years, essentially, crypto has increased the use cases massively. And so the challenge of the service providers today is really to ensure that they can serve at best all of these use cases that an investor wants to go after. There is another major point to the adoption of crypto, and I guess you have heard about stablecoins. So stablecoins are, as the term says, a stable currency that is pegged to usually the dollar, because of course, well, it's the dollar, it's the global reserve currency. That's what it makes sense to do. The way that crypto stablecoins have evolved today is around mainly four typologies. You have the backed coin, one-to-one, meaning that for every digital US dollar, there is a physical US dollar somewhere in a bank. And this is the case of Circle, USDC, this is the case of USDT. And actually, these are the most used stablecoins today because they are also filling better the regulatory framework. Then you have over-collateralized crypto coins. This is a very interesting concept because it's essentially allowing, allow me a nerdy term like crypto banks, crypto autonomous banks. So imagine that you have a house, yeah? And you go, what do? You have your own house, you go to a bank, you can ask a loan against this bank, right? Against this house, sorry. The bank will give you some money and will charge an interest rate for it. Similarly today, you can take your tokens, Ethereum, Bitcoin, you deposit them into a contract or into an application that is not managed by anyone, that is just programmed to give you money, give you dollars, in a ratio that, of course, is less than one-to-one to the tokens that you have deposited. So if you're depositing $10,000 worth of Bitcoin, that application will allow you to get maybe $5,000 in exchange. This means that you can loan against yourself for property that you have, and you don't have an intermediary for it. And it's very important to know that during this summer, when crypto fell apart, essentially, and much of it was because of DeFi, none of these projects flinched. They all worked as they were supposed to work. So there were a lot of liquidations, but there was no hole. Maybe you have heard of Luna, which is the fourth algorithmic type. That was quite of a disaster, to be honest, but because this is another type of coin. Algorithmic stable coins, as the terms say, they are based on an algorithm. They also have an underlying asset which try to rebalance whenever the stable coin is fluctuating too much. What happened with Luna is that the markets exploited the demand or the demand-supply forces to essentially skew too much the price of the stable coin away from its pegged value of $1, and therefore this had a ripple effect on the underlying collateral, thereby failing the full system. It was, of course, a huge loss for many people because we're talking about 16 billion burned, and the people who made a profit out of it made about 1 billion. But it's also true that because crypto is transparent, you could have seen that Luna has this technical flaw. I cannot see because I'm not a developer, but there were a lot of developers out there that were saying, this coin works because people believe in it, not because it's technically secure. And when people stop believing in it, that's what happened. So, are these stable coins useful? Yes, they are. They really are driving adoption. We see in certain countries especially that stable coins are used already for actual means of exchange. In Africa and Latam today, and Latin America, especially in the tech workforce, 10% of these people already demand to be paid in crypto, even if they're not working in crypto. That's insane, but that's also because many of these economies today are suffering for heavy currency devaluation. And that's the other benefit of crypto. Because stable coins are not censored, there is no central authority here, everyone can get access to it. You don't need a bank account to have digital dollars. You need your phone. Everyone has a phone. So with crypto, you can really facilitate financial inclusion. You can facilitate currency diversification if you need to. And with that, you can also support remittances. So, and in this manner is also a very cheap way remittances today are calculated to cost on average 6% of what you send. That's a huge amount of money. For sending $100 of crypto today, you would spend probably around 11 cents, and that's nothing. So, and of course, last but least, most of investors are looking for yield generation, which is, again, up until today, despite the growth of interest rate, is still higher than what the bank could offer. So stablecoins are really driving adoption. There is a fifth type of stablecoin that is very important to mention, but it's still much more of a project. There is central bank digital coins, digital currencies. So they very much would behave like the stable coins, the private stable coins that we see today around, except that, of course, being issued by the central bank, it would have much more legitimacy. It would be the de facto digital legal tender. It's also true that these stable coins would, just like the other ones, cut down the middleman. So why don't we see them? We know that there are 105 central banks that are currently studying such a project. We didn't see anyone yet. China is testing it in some cities, but China is a bit different from other countries. The country there is already very much digital in cash management. So the reason is that there are technical reasons, but also some demand concerns. Yeah? In a survey from the ECB, the main concern that people had into adopting a digital euro was indeed privacy. They don't want the digital euro to be a way just to be, again, giving away data. You know, that we have cash today. Cash is completely anonymous. Crypto is not anonymous, it's pseudonymous, but a digital currency issued by a central bank could be totally transparent. And that's something that not so many people apparently want. They have also competition from the other currencies. Today, if we think of crypto, the stable currency that exists, they account for 60% of the total market cap, so 150 billion, more or less. That's already a lot of money involved in it, and there is actually transacting $1 trillion per year. So that's already something that competes with the central fintech, at least. So last but least, technically, if you are a central bank, it's very hard for you to decide if you want to support protocol A or protocol B. Like, it would be like taking a political stance. As a central bank, Europe, like, why would I choose to build on Ethereum or on Polygon or on Near? That's really making or breaking the faith of the other network. So there is some ethical concerns around this as well. So either way, no matter how they are evolving, it's true that they're having a real impact, and they have the potential to shape the future of money. I think one topic that I didn't touch enough in this presentation, but it's definitely worth mentioning, is regulatory framework. Without growing and comprehensive regulatory framework, stable coins would not be around. People would not be able to use them. So what we see with the FATF or the MiCA regulation coming up in Europe, these are key moments to define the industry and to make sure that stable coins do become adopted. It's also, though, you see from the demand point of view, is that stable coins are bridging users, because if you're not a very crypto-savvy or tech-savvy user, you will not maybe engage into buying Bitcoin. You just don't want to figure out because that's complex. But you wouldn't mind having a stable coin in your wallet. That's very easy to get. You pay with your credit card, now you get the digital version of the euro. Why is it so? Because it's not so different from what happens today. Think PayPal, Revolut, Alipay. These are already networks that have a lot of dollars parked into it, and they have a lot of users that are exchanging dollars over this network. That's a stable coin. It's just they don't want to call it that way because otherwise they have a lot of regulatory pressure, but de facto, that's a stable coin. And so it's very easy for a customer, for a retail user, to make that switch. Now I'm not on the Revolut network anymore. I'm on an open network that is called Ethereum, and I'm using something that's called USDC, but it has the name USD in it, so I know it's dollars. And I can very much send it with the same ease that I can send money on Revolut. So this is what we see that is going to help and thrust stable coins into the future of money. So, having said all of these use cases, why I'm here, what do we do at Finoa? Well, we try to help people or institutions that want to enter into this space and they want to participate. So, very quickly, we are a young company regulated by BaFin. We were originally born in Berlin, and we opened an office in Porto at the beginning of this year. Now we are almost 100 people with 300 institutional customers and a good portfolio of assets. Why do customers come to us? For what I was saying before, they want to enter crypto, but it's not just about buy and hold. They want to have ownership of their assets, especially after what happened last summer when people really lost everything because they entrusted to companies that were not doing proper risk management, whereas with a custodial solution, you're always in charge of your own assets. You own your keys. And with that, you can also actually access many different use cases that today crypto is offering. So everything that is from brokerage, custody, and in-custody staking is what customers look for Finoa for. It's also reminding that this typology of investor I was talking about before are the ones that mostly seek company like ours. So predominantly you see crypto-native VCs, asset managers, but it's very interesting to now see companies like from telcos, companies from the sports world that want to engage in NFTs for their communities. They all want now to start dipping their toes into crypto. This means that we have a lot to do. We're still at the base layer, but growing, planning to grow a lot the number of use cases that we want to offer, planning to grow a lot the number of digital tokens and that we want to offer to our customers. Hope you enjoyed it. If you have any questions, I hope we have some time. Otherwise, happy to keep in touch with you. Thank you.